Hi everyone. Today it is my pleasure to be with Kari Vatanen. Kari is Chief Investment Officer at Veritas Pension Insurance.
Hello, it's nice to be here with Florian today.
Thanks. We are going to discuss a very interesting question, which is basically the following. What will we see in terms of changes in the investment community once we put this pandemic behind us? We'll answer that question from three different angles, the shorter term, the medium term, and the longer term. And today we'll be focusing on the short term consequences of seeing an end to this pandemic. What will it change in terms of the investment world? I'm going to kickstart, if you don't mind, on this shorter term perspective by showing the slides you should see now in front of you. The starting point, in our opinion, is to acknowledge the fact that we are currently seeing a very significant recovery, as you can see on the chart in front of you on the left with the blue line, which shows our US growth nowcast, which is an indicator we use to gauge the pace of economic activity. There is a very strong recovery at work in the US, and not only in the US, but actually across a vast majority, I would say, of countries around the world, across the 83% of world GDP we're looking at. That on its own should be enough, given historical correlation, as you can see on this chart, to see higher rates. The first consequence, in our view, of this short-term perspective of putting the pandemic behind us is higher rates. Now, that comes with another trigger, which you can't see on the slide, but which I'm sure you've read about, which is the inflation situation. We're currently seeing inflationary forces building, and we think the combination of growth and inflation together warrants higher rates. Now, what does it mean in terms of investing? The answer, in our opinion, lies on the chart on the right, which shows the duration, so the sensitivity to long-term rates of different types of assets. Most people would be focused on fixed income securities, highlighting the duration risk implied in fixed income securities, but we argue also that equities, to some extent, are also showing a sensitivity to rates. And when you compute the duration of equities, as you can see, world equities have a comparable duration to fixed income securities, to world bonds indices. Having that in mind, Kari, how do you see the current evolution, and how does actually it impact the evolution of markets?
I mostly agree, but I'd like to add there an issue. Uh, we can divide the progress of US rates to the two different components, and as you see on the graph on the right, the break-even inflation is a one component, and another component is the real rates. And while inflation expectations, they have risen for last 12 months since the bottom of COVID crisis, instead real rates have been at a very low level until last few weeks. But now, when real rates are started to rise due to the massive fiscal stimulus, and that's also expected to happen, expected to continue now on. And the main reason for that, well, you can see that on graph on the left, the main reason is that the massive fiscal stimulus will continue. In the US, there has been approved a massive fiscal stimulus package, and that will increase personal income. And when the pandemic will be over, that will boost consumption in the economy, and the whole economic growth will be higher, and that will boost also inflation expectations higher.
So the first answer to the question would be basically that we both see higher rates in the shorter term. That's how the investment world will basically be impacted by the end of this COVID period. I would say the only thing that we see that for different reasons. On our end, we see a combination of growth and inflation forces pushing rates higher, and on your end, you see the fantastic stimulus as the key source of the revision of this growth premium in rates. Is that a fair summary of our views?
Yes, that's right. That's good.
Thanks, Kari. Thank you very much for being with us today, and for your slides and ideas. Bye bye.
Thank you. Bye.